Over 1 million people around the world follow Wall Street veteran Mark Chaikin for his shockingly accurate stock market predictions, and he just gave them a dire warning. Mark says we're about to witness a historic stock market shakeup that could soon create devastating losses for investors who don't know what's coming. And as a result, you only have 90 days to move your money. You see, Mark spent 50 years on Wall Street at some of the most prestigious hedge funds in history, and he's been on Fox Business and CNBC countless times. But this is a financial story no one else is telling. And if you let this take you by surprise, you could be in for a world of pain. He explains everything in a brand new free report available at rollingcrash.com. He includes the name and ticker of a popular stock that could be directly impacted by what's happening as well. Mark warned of beloved pet brand Chewy before it fell 45%, tech company Sea Limited before it fell 66%, furniture company Wayfair before it fell 76%, social media favorite Snap before it fell 36%, and food delivery company DoorDash before it fell 65%. Mark even called the Amazon crash before the famous FANG stock fell 35%. So you'll want to avoid the stock in his new report immediately. Again, simply go to rollingcrash.com for your free copy of this new report. Hi, this is Daniela Cambone. Welcome back to the Daniela Cambone Show. Summer in full swing here in Montreal, Quebec, Canada, my hometown, where I'll be continuing with our coverage throughout the summer. Today, this Wednesday, we're talking Fed Reserve Chairman Jerome Powell, who talked tough on inflation again, saying at a forum in Portugal that he expects multiple interest rate increases ahead and possibly at an even more aggressive pace. Here to talk about this and so much more is Will Rhind, CEO and founder of GraniteShares. Will, always good to see you. Welcome back to the show.
Thank you for having me. Always good to see you too, Danny. Thank you for having me.
Yeah, so let's dissect the latest here from the Fed chair. Powell, speaking in Portugal earlier today, said, "We believe there's more restriction coming," right? What's really driving it is a very strong labor market, basically telling us, get ready for more rate hikes. I mean, is he taking a cue from the Bank of England here, Will?
Yeah, it seems like quite possibly. We'll have to see. I mean, I think, after the last meeting, clearly the market was thinking 2 rate hikes, possibility before the end of the year. I'm not sure nothing, or if anything, has really changed in terms of his comments. He's talking about the potential for back-to-back rate hikes. But, I think that we have to be a little bit careful at the same time. And that's why the response from the market so far has been a little bit measured on the back of those comments.
Now, Will, let's look at markets taking a hit from his comments. I mean, gold slipping on the news, but you say prices remain resilient despite the fact he's signaling more aggressive rate hikes coming.
That's right. I mean, I've been quite surprised, pleasantly surprised, I suppose, at how gold has stuck in here, really quite in a fairly firm way, I think a robust way, given this backdrop. And I think a large part of that is to do with the fact that the market does see rate hikes, an end to rate hikes, and obviously inflation, the most important thing, coming down. We saw some potential for market chaos, obviously, over the last weekend with what was going on in Russia, but that seems to have dissipated somewhat. So I think gold prices are going to struggle a little bit here, given the fact that we had some very strong data come out yesterday about the U.S. economy, particularly around the housing market, and as you said, Danny, the labor market. And then you have the other side of the coin, which is the double whammy here, is that the Chinese data still looks poor. So imports of gold from Hong Kong into China was lower last month. And, we still see that economy is stuttering, although clearly the Chinese government is now talking publicly about stimulating the economy, which I think will be a good thing for gold. So gold is sort of caught in a little bit of a funk at the moment between those two factors.
I mean, Will, do you think that they're going to be aggressive up until the presidential election? I mean, do you find it interesting that they're being so aggressive now? I mean, I think that it just has to happen. I mean,
real estate market, has been in trouble. The economy showed a weakness, and I think that we're going to see more stimulus coming into the economy. That is what I think we'll start to see.
Also under pressure is Bitcoin this morning. I mean, we saw some renewed energy and enthusiasm in the space, obviously with the news of BlackRock looking to launch a spot ETF. The spot ETF is something that the crypto market has been hungry for so long. And now Fidelity, asset manager Fidelity, is expected to file with the U.S. securities regulator for a spot Bitcoin ETF. So why now? Why the emergence of all these giants in the spot ETF Bitcoin space?
Well, this is a great question, and probably the question of the hour. And of course, this all started with BlackRock filing for a spot Bitcoin ETF, which I think caught people by surprise. And of course, as I'm sure viewers of your channel will know very well, that this has been an ongoing saga for years that has played out with lots of different players, lots of different applications. But the short answer has been so far that the SEC has rejected everybody and has seemed to be very negatively positioned against the spot Bitcoin ETF. So why suddenly does BlackRock file seemingly out of the blue for a spot Bitcoin ETF? Now, clearly people that are familiar with the market would say, well, what do they know that nobody else does? And have they been given some kind of information or some kind of, information that would imply that they now have a chance to do that? We don't know, but clearly that is, what the market is thinking, and that's why there's been this renewed interest in Bitcoin over the past week, as the chances or the probability of a ETF getting approved, a spot ETF approved, seems like it's ticking up.
You would think that they would feel deterred to do so, given the recent crackdown on Binance, on Coinbase. Obviously, it looked like, Operation Chokehold 2.0 was in full effect. And yet, all of a sudden, these giants emerge saying, oh, no, now we're interested in the space. So back to your point, the timing of it all. And the second point, Will, is why does BlackRock get the green light after so many others have failed?
Yeah, I think that, again, this is a saga that's been going on for some time. And, we know about the grayscale, GBTC or the Bitcoin Trust, which is, in effect, a closed-end type structure. And then on the other hand, there have been futures-backed products that have been allowed to list, so Bitcoin futures. And then actually just yesterday, a 2x leveraged Bitcoin futures ETF made its debut in the market. So there have been all of these other sort of adjacent products that have been allowed to list on the US market, but not a spot Bitcoin ETF itself. And so maybe this is the sign that some kind of pathway has been cleared now, but who knows?
Will, I know in the past you hadn't fully embraced Bitcoin. Does this give you a change of heart here on the asset?
To be honest with you, not really. I think from our perspective, it is interesting. I have certainly spent a lot of time looking at it and trying to understand it, but I still feel like the reasons that people are getting excited about it don't make too much sense to me at this stage. So it's not something that we're going to be rushing into the race with at the moment, but we'll see.
Also, we're just around the corner from the launch of the FedNow payment system that the Federal Reserve has worked on. Your thoughts on FedNow? Will it be a game changer to the financial system, Will, or not?
It's hard to say, Danny. I mean, there's some aspects of it that clearly it's designed first and foremost to really help with retail payments and make retail payments instantaneously, 24 hours a day, 7 days a week. And from that perspective, that is, in of itself a positive. I'm not sure, though, that, for those that use services already like Venmo and Zelle, etc., it's going to make much of a difference. And of course, depending on, what bank or payment provider you use, they'll have to sign up to FedNow for you to be able to use that service. So I'm not sure what the sort of instant impact will be, but on the surface of it, clearly it's designed to try and improve the whole payments process, which I suppose, going back to the cryptocurrency thing, was one kind of criticism that people are trying to chip away at in terms of the payments infrastructure and trying to make that more efficient, more instantaneous.
Will, just finally to wrap here, is there anything that you're really eyeing or of concern to you right now in the markets? The wild card.
The whole metals complex today, Danny, is under pressure, and it's not just gold, but we're seeing silver and platinum, palladium, and I think even the strongest story, in my view, out of the four of them at the moment in the platinum market that, as we know, is huge deficit, about 1 million ounce deficit forecast for this year, it's the largest that we've seen in recent years. Power outages in South Africa, but even that metal coming back now to where it was in March, at about the March lows. So it could be a buying opportunity for platinum, but I think it just shows that we're seeing strong U.S. numbers coming out from the economy, which is really the main thing that's dampening demand for the metals right now.
Will Rhind over at GraniteShares, appreciate your insights. Thank you so much for joining us this Wednesday.
Thank you, Danny. Thank you so much for having me.
Happy summer, Will. We'll see you soon. And thank you all for watching. We'll have more great content coming your way, so be sure to stay tuned to the Daniela Cambone Show and sign up at danielacambone.com. Thanks for watching.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.